Welcome to the Roundup covering what's important to accountants and advisors across the month of September. This month we'll look at the new draft ruling on self-education expenses. We'll also look at the legislation before Parliament increasing the cap for the instant asset write-off. But first up, clarification on the technology boost and the sting in the tail for shareholders. Michael, the technology boost is notoriously vague. The ATO have released some clarification. Will this actually help the profession work through the expenses that are eligible for the boost?
That's a really good question. And the ATO's latest guidance will certainly help when it comes to clarifying at least whether some expenses are eligible or not. But look, it doesn't go the whole way of giving us a black and white list of all the things that are going to qualify or won't qualify. The thing I think out of this latest ATO guidance that is the most helpful and answers one of the most common questions certainly that we've been receiving in connection with the technology boost is the question around ongoing expenses. So if you compare the technology boost and the skills boost, one of the features of the skills boost is generally the expenditure can only qualify if it relates to a course that someone has enrolled in during the boost period. This technology boost, though, is worded a little bit differently, and it doesn't contain anything to suggest that expenditure relating to pre-existing commitments can't qualify. However, there has just been a bit of a question mark over that. Well, the ATO has confirmed that the expenditure doesn't need to be brand new in order to qualify for the technology boost, but it does need to be incurred during the boost period. So, really good example of that is the ATO discusses a situation where a business might have an ongoing subscription for some accounting software that is used in connection with the business activities. And that subscription has been in place for a period of time prior to the boost period commencing. The ATO confirms that even though that subscription was already in place, the fees, the charges that were incurred during the boost period can still qualify for the technology boost. So in terms of does the ATO guidance help us in determining whether expenses are eligible or not? Yeah, it does to some extent, particularly around that distinction between existing and maybe new commitments. The ATO also provides an example which I think is helpful to some extent, but again, it's a little bit limited and it's not going to help you figure out the answer in every case. The example that the ATO gives is around a business that goes out and spends some money acquiring a multi-function printer. The ATO says, look, if you're planning to use that printer just to make paper copies of documents, then it doesn't really qualify. However, if you're planning to use that machine basically to convert paper documents into digital form so that you can store them and use them in a digital forum, then that probably would qualify. So it's very much about looking at what the business intends to do with the thing that has been acquired or obtained from incurring the expenditure. But look, the guide is pretty brief and we still are grappling with a whole lot of really practical scenarios where it's not entirely clear certainly whether the expenditure is meant to qualify or not, and we're not entirely clear how the ATO is going to approach this, particularly if it comes down to a review or audit situation. You would hope the ATO is reasonably flexible, but we really don't know, and we're not going to know that for some time. So look, yes, the ATO guidance does help to some extent, but there is still a lot of grey when it comes to applying the technology boost, and we really still do need to exercise a pretty high level of judgment when it comes to determining whether expenditure is eligible or not.
Well, it looks like the technology boost is a win for taxpayers that can qualify, but is there anything we should be aware of when it comes to overall tax benefits that are available when accessing this boost?
Yeah, the technology boost is, I guess, a lot like other concessions that have been made available by the government, something that certainly can provide a short-term benefit, particularly if a taxpayer is in a tax payable position. But it is something that we just need to be a little bit careful about, particularly when we're dealing with company clients and also unit trust clients as well. And really what we need to be on the lookout for is while the company or the unit trust might be able to claim a bonus deduction and reduce company tax payable or the total assessable amount that ends up being taxed in the hands of, say, a unit holder of a unit trust, there can be an indirect hit to certain parties as a result of the application of an incentive like this. Let's just use the example of a company to start with. When a company qualifies for the technology boost, we have this bonus 20% deduction that's claimed on top of the normal deduction for the relevant expenditure, which means that we're reducing the company's taxable income further than it would otherwise be, which means there's less tax paid by the company, assuming it's in a tax payable position, but that also means that we're generating fewer franking credits. Now, in the short term, that may well be not a problem, but at some point, your client might want to take the profits out of the company, and that would normally be done in the form of a dividend. Well, unless the company has some surplus franking credits sitting in its franking account, it might mean that we end up paying a partially franked dividend rather than a fully franked dividend. Now, if you run the numbers, basically what ends up happening is that the shareholder can potentially end up paying a bit of extra tax on the dividend that they receive, and that extra and also with the proposed energy incentive. Similar thing, bonus deductions at the company level, but we could potentially end up clawing the extra tax back at the shareholder level. Surplus franking credits might help with that. The problem for unit trusts is a little bit different. If we have a unit trust situation and a distribution is made to unit holders where the amount they receive ends up being more than their share of the taxable income at the trust level, then that differential, that extra amount that they receive, can end up being picked up through the CGT system. There's a CGT event E4 that we would normally consider in a case like that. And so while the unit holder might have less tax to pay on revenue account, it may well be that they end up with a CGT liability, either straight away or possibly later down the track when they dispose of their units. So just need to look at the big picture. When the government offers incentives like this, yes, short term, there certainly can be a benefit, but we just need to look at, well, what happens later down the track when the profits that have been basically sheltered through extra tax deductions come out of the entity into the hands of a shareholder or unit holder. There can sometimes be flow-on additional tax consequences.
The ATO have released a new draft ruling on self-education expenses. Matthew, what are some of the highlights of the ruling?
Well, the ATO have withdrawn their two existing rulings in this area, so TR 92/8 and TR 98/9. Both of these rulings have been withdrawn and been replaced with a single draft ruling, TR 2003/D1. Like with some of the other areas in the tax law, like personal services income and residency, the ATO have been slowly withdrawing some of their older rulings, consolidating the principles into a single ruling, and that's what's happened here. And in that process, what the ATO have done is that they've taken the opportunity just to update that guidance so that it's more in line with more recent court decisions. So what I'm trying to say is that the fundamental core principles remain the same. In fact, many of the examples in the older withdrawn rulings have basically been carried over to this new draft ruling. And look, subject to any specific exceptions, so the main one being course fees for a course that's subsidised by the government under a Commonwealth-supported place, self-education expenses are normally deductible if they're incurred to maintain or improve someone's skill or knowledge that's required in their current role. Or otherwise, deductions are often available if they're incurred on courses that are likely to increase someone's income from their current role. And the key point here is is current role. And there's an emphasis on that. And that's because self-education deductions and undertaking a course that's designed to obtain a new job or designed to open up a new income earning activity, those expenses won't normally be deductible because they're incurred too soon, right? Those expenses are incurred to put someone in a position to earn income, which means those expenses won't normally be deductible. And that principle, those principles remain the same in this draft new ruling. It's just that the ATO does provide a bit more clarity, a bit more certainty in certain situations and in certain areas.
You mentioned the draft ruling provides clarity in certain areas. What are some of the highlights that we should be looking out for?
Certainly. While still in draft form, look, the ATO's new ruling does provide a bit more clarity, a bit more certainty for certain situations. In terms of highlights, I think the first and I guess the main highlight is that the draft ruling does now explicitly deal with scenarios where someone might have quit their job or lost their job partway through undertaking what would otherwise be a deductible course. The ATO now says that deductions for expenses incurred are available only up to the point in which that person's role ceases. Presumably, if that person gets a new job, then we reassess deductibility from that point onwards. The second thing I think is worth mentioning is, look, and this principle's been there in the old ruling that's been withdrawn, and it's still maintained in this new draft ruling, is that interest deductions on loans are available if those loans have been used to fund deductible self-education activities. It's just that the ATO makes it quite clear that indexation on government loans is not interest, and you can't claim deductions for indexation of government loans like fee help loans, HECS debt loans. That's just the position, but it's just nice to see that the ATO have put something out there that formalises this position in a ruling, although it's still in draft. The last thing I think is just worth mentioning is that in some cases you might find that the course fees for a course might not be entirely deductible. A good example of this is an MBA course that might be seen to be too general, at least for some occupations. But there might be some particular subjects, some particular modules that have a stronger relevance, a stronger connection with the client's current role. And the ATO says in those cases, you might not get a deduction for the entire course fees, but you still might be able to get some, right? You might still be able to get some deductions for those particular modules, those particular subjects that have that stronger connection. And this position has been, I guess, mentioned in some of the ATO's older guidance. It's just nice to see that the ATO, again, have formalised this position and put something in there in this new draft ruling. So look, if you've got clients that are undertaking self-education activities and you're not quite sure where they sit in terms of deductibility, it's not a bad idea just to take a look at this new draft ruling and see if it can help provide some clarity for you.
Legislation introduced into Parliament contains a series of the budget measures, one of which is the increase in the cap for the instant asset write-off. Michael, who will benefit, and really what are the practical issues here?
Yeah, so a number of budget announcements back from May 2023 federal budget have been included in this particular bill, and the first one to note is this instant asset write-off threshold, $20,000 threshold that will apply at this stage anyway, only for the 2024 income year. So you might recall we've had a whole series of changes around the depreciation rules over recent years. The temporary full expensing rules finished on the 30th of June 2023. The instant asset write-off for small business entities was due to drop back to $1,000 from 1 July 2023, but the government announced that that would be a $20,000 threshold for just 1 year, the 2024 income year. Now, this isn't legislation yet. This is a bill before Parliament, so we're not quite at the stage where this is law, but it's certainly getting closer. The $20,000 threshold, probably the key thing to note here is that it is much narrower than the temporary full expensing rules. The government allowed entities with significant turnover to access the temporary full expensing rules, very much linked to kind of stimulating the economy through the COVID period. This is very much aimed back at small business entities with aggregated annual turnover of less than $10 million. So we're coming right back to that $10 million threshold when it comes to this depreciation measure. Now, a couple of things just to remember on top of that. First one is that small business entities can only access this instant asset write-off if they choose to apply the simplified depreciation rules, and that would be for the 2024 year. We've seen over recent years a whole range of choices being made by smaller business entities, sometimes because those entities didn't want to use the temporary full expensing rules or wanted to choose which assets those rules apply to. So we've seen a lot of smaller entities kind of leave the simplified depreciation rules, at least for the time being. Well, if they want to take advantage of this $20,000 threshold for the 2024 year, they need to re-enter the simplified depreciation rules for the 2024 year. The other thing to note, and we've been asked about this quite a lot already, is the lockout rules. So normally when a business has been using the simplified depreciation rules, continues to be classified as a small business entity, but chooses to not apply the simplified depreciation rules for some reason, well, they're normally locked out of the simplified depreciation regime for a 5-year period. However, those rules have been suspended or paused for quite some time now. While we've had these increased write-off rules, the government has continued to pause those rules. Well, they've done so again, or will do so, assuming the legislation passes. So once again, there's an opportunity for a bit of flexibility in terms of entities leaving and coming back into the simplified depreciation rules. Just that extra bit of flexibility that would not normally otherwise be there. Final thing to note is just remember that these instant asset write-off rules only aimed at assets that effectively fall within the scope of the depreciation system, kind of the Division 40 depreciation asset rules. Remember, capital works expenditure is dealt with separately and won't qualify for this measure. We find that particularly when clients are doing things like building fit outs, that sort of thing, there'll often be an exercise that needs to be undertaken to identify expenditure that falls within Division 40, so depreciating assets, and the expenditure that falls within more Division 43 capital works rules. And we do need to take a bit of care around that to make sure that we've classified that expenditure and those items and assets correctly. Only assets that would fall within the scope of the Division 40 depreciation rules can then be brought into the simplified depreciation rules and then qualify for that $20,000 instant asset write-off.
Is there anything in this bill of note that practitioners should be aware of?
Yeah, the bill contains a few different measures, but probably the one we'd pick up on at the moment is the small business energy incentive. This is another measure that was announced back in the May 2023 federal budget, and it works a little bit like the technology boost and the skills boost to some extent because it provides bonus extra deductions on top of the normal deductions that would be claimed for eligible expenditure. Now, we're hoping that this bill does pass through Parliament pretty quickly, and one of the main reasons for that is to give taxpayers and practitioners certainty around the application, particularly of this incentive, because this incentive is only aimed at the 2024 income year, and we're already working our way through that year. So time, to act on this is starting to run out already. The small business energy incentive is aimed at businesses with aggregated annual turnover of less than $50 million. So I guess we'd call it small and medium-ish type businesses. So operates a little bit, again, like the skills and technology boost in terms of what type of entities would qualify. And this is a boost that is subject to an annual cap. The cap is a $20,000 bonus deduction, which would equate to $100,000 of eligible expenditure. To qualify, the asset that you acquire needs to be used or installed ready for use between 1 July 2023 and 30 June 2024, or if you're improving assets, that expenditure needs to be incurred during that same period. Now, there's a range of things that could potentially qualify for the small business energy incentive. For example, if you go out and buy a depreciating asset for use in your business and it is more energy efficient than other products that are on the market, or it is more energy efficient than an existing asset that you already use in your business. So you're replacing an existing asset with something that happens to be more energy efficient. It can also apply to assets that are used to monitor electricity usage, for time-shifting devices, and also for storing energy as well. Improvements to existing assets can also potentially qualify, again, if they're really aimed at improving energy efficiency. So there's a whole range of things that could potentially qualify, and probably to some extent a little bit like the technology boost, we will need to exercise some judgment when it comes to this, because there will be a little bit of grey around the edges in terms of what will and won't qualify. Now, there are some things that specifically don't qualify for this boost. First thing is expenditure on electric vehicles won't qualify. There are other concessions potentially out there that you could take advantage of when it comes to electric vehicles, for example, the relatively new FBT exemption, but this boost won't apply to expenditure on an electric vehicle. Expenditure on financing costs also won't qualify. So if you go out and buy an eligible asset, but you have to borrow money to acquire it, there's some interest expenses being incurred. Those interest expenses might be deductible under normal provisions, but you won't qualify for extra boost deductions on top of the normal interest deduction. However, the boost could well be available for the asset that you've acquired. So there are certainly some carve-outs from the rules that we need to be aware of. There are a range of things that could potentially qualify, but this is time limited. Clients really need to do something about this to take advantage of the incentive by 30 June 2024. And at this stage, we're hoping that that bill does pass soon so that clients can act on this with a higher level of confidence and comfort.
And that's a roundup for this month. If your firm is not a member of Knowledge Shop as yet, we'd love to show you what a difference we make to thousands of accountants and advisors across the country every single day. Give the team a call or jump onto the website and book in a time for a tour. We'll really look forward to speaking to you.